There are a million reasons to hate bonds right now. Everywhere you look, you hear commentary about bond kings saying the secular bull market for bonds that's been going on for 40 years is coming to an end. Everyone's screaming about rates rising. This year, for the first year in a long time, you actually have negative returns for the Barclays Aggregate Bond Index. But Mike, I think people forget why they even bother owning bonds in the first place, like why they're even in the portfolio.
Yeah, and I think that we're fortunate to be focusing on the risk of bonds because stocks have done so well that we have nothing to worry about on that side. But in a 60-40 portfolio, 90% of the volatility is from stocks. Stocks are always the risk. So bonds are getting crushed. They're down 2.3% this year.
That's considered crushed for
right. So the worst year for the ag going back to 1976 is negative 2.9%. It's like a bad afternoon for stocks.
Right, you could see that in one day in the Dow on no news, and that's like a bad bond year.
Right. So people think that we've been in a bond bull market for 35 years because rates have been falling.
Right.
But our friend Corey Hofstein showed that 75% of the return going back then, it's not from falling rates, it's from a high starting rate. Right? So if you want a return from your bonds, I hate to break it to you, their interest rates are going to have to rise.
That's the only way you'll make money on new dollars going into bonds.
Right. And if you don't like bonds at 3.5%, well, you could hold cash if you want. I mean, cash is now yielding something. Or you could hold more stocks if that's your prerogative. But if we're worried about the behavioral risk and getting scared or excited, that risk lies with stocks, not with bonds, always.
So if you're at risk of behaving badly in a portfolio and doing something that's going to jeopardize your future retirement, the source of that risk of you doing that is not going to come from the fixed income portion of your portfolio.
From 1941 to 1982, the 10-year went from 2% up to 15%, and the worst nominal loss on a calendar basis was 5%.
Right, so just a terrible series of years in a row for bonds, and your worst year in that year was 5%.
Right. Now you got crushed on a real basis, obviously, because inflation was spiking. But
that happened for you in
nominal
stocks eventually.
Right,
too.
Nominal declines in bonds are not the risk to really, really, really bad behavior. It's stocks.
Right. The other thing, and we always talk about stocks for the long term, and of course it makes sense. You're taking more risk. You should have more reward over long stretches of time for stocks, and that does work. But it doesn't always work in every long-term period. You had a post up, and you were basically saying there is a period of time going into June of 2009 where on a 5, 10, 15, 20, and 25-year basis, long-term treasuries actually outperform stocks.
Yeah, so I got that from Jason Zweig, and the point of that article was not saying anything about going forward. It was just the limits of historical data. There are no ironclad rules. Yes, stocks usually work for the long run, but sometimes not always.
Right, so this idea that, you know what, bonds have been a drag on my portfolio this year, why are we even bothering? I know rates are going up. I feel like I'm going to have even more drawdowns. I think the final point here is it is very rare to have a situation where you lose money in both stocks and bonds in the same U.S. stocks and U.S. bonds in the same year. You looked at that before.
Has not happened since 1969. Now, of course, rising rates could drag down bonds and stocks as well, and that's what risk is.
It absolutely could happen, but in the last 50 years, give or take, it has not happened. So if you're building a portfolio and the idea is you want offsets to control your own behavior, yes, it's tempting to look at the thing that's a drag on returns in any given year and say, why do I even bother? But I think if that's, if you're worried about the risk of not making enough money because fixed income is not doing well this year, I think you're totally rearranged in the head. No offense. No disrespect. Got anything to add to that? All right. Thanks, Mike.